Hi, I'm Jacob Hornberger, president of the Future of Freedom Foundation. This is this week's issue of the Libertarian Angle, the show that brings you the libertarian perspective on what's going on in the world. And I'm joined, as I am every week, by my co-host, Richard Ebeling, who teaches economics at the Citadel. We've also got a special guest that I'll introduce in a minute. But Richard, good to see you again.
It's great to be back here with you and our very special guest, my old and dear friend.
Yeah, friend of both of ours and a longtime friend of the libertarian movement, Larry White. Larry is one of the heroes of the libertarian movement, I might say. He's influenced
shucks.
countless students. He's a professor at George Mason University, well known within the Austrian economics community, the libertarian community. Got his BA at Harvard, his PhD at the University of California at LA. He got an honorary doctorate from Francisco Marroquin University. He's written, gosh, I don't know, written or edited some 10 books. But Larry, what you're really known for in the libertarian movement, in addition just to being an Austrian economist, is your work on banking, free banking, monetary policy. So why don't you start out the program by just giving us a little synopsis of Austrian economics and the monetary philosophy of Austrian economics, where the concept of free banking fits in this, and just kind of assume that the viewer is first being introduced to these concepts during the show.
Yeah, the way I like to say it nowadays is that I was writing about private money before Bitcoin, decades before Bitcoin. So I started with an interest in the historical episodes of competitive private banknotes. And in particular, I studied the case in Great Britain where Scotland had a very successful free banking system. And there was a debate in London as to whether England should adopt this system or suppress the Scottish system. And it was the second option that they ended up taking. But this fits into Austrian economics back to Mises' first famous book, Theory of Money and Credit. If you read it carefully, you'll see he's very aware of this debate over central banking versus free banking and talks about the properties that competition brings to a system of note issue and makes the point that this system will regulate itself. That the banks, if they're not formed into a cartel or not being compelled to all behave the same way by a central bank, will behave in a way that checks one another. Banks won't want to, a good bank won't want to throw its reputation in with a sketchy bank. So banks will, when they, in the course of business, get hold of claims on other banks, checks and banknotes, they will take them back for redemption. And this process of draining gold reserves from the banks that overissue will keep the banks in line. And then at the system-wide level, the system can lose gold to the rest of the world if it's overly expansionary. So this is a case where the market doesn't fail. It provides a self-regulating system that works to the benefit of consumers.
So you're talking. It sounds to me like. Yeah, let me just say one more thing, Richard, and then I'll turn it over to you. It sounds to me like what you're talking about. You know, during the Ron Paul campaigns, presidential campaigns, there was that famous mantra that he made famous in the Fed, and it sounds to me like what you're talking about is the principle that you don't really need a central bank to plan the banking sphere, the monetary sphere, and that your concept of free banking is a system where the free market is just, banks are just competing against each other in a free market context. Is that right?
That's right. I mean, it was a mistake to ever start the Fed, is kind of the point of it. And it's a mistake that's just taken for granted by so many economists today. We have a central bank. There's no question about its operation. Let's just try to tinker with it and make it behave in a better way than it's been behaving. But there really wasn't the need for a central bank at the beginning, because the operation of the gold standard together with competition among the banks regulates the quantity of money quite nicely.
Hey, Richard, you've written a great book for us here at FFF called Monetary Central Planning in the State. You yourself,
I love that book.
Yeah, you yourself
you.
are a real expert, Richard. So take it away.
Well, the real expert has joined us today, but maybe for our viewers, because as Jacob was saying, some listeners and viewers might not understand all these controversies and different views. The fact is, as you were saying, we do have a central bank today. It's taken for granted. The president nominates members to its board, and who'll be the chairman and everything, and the media goes ooh and ah over everything that the Fed does in terms of interest rates and so on. Maybe you could take a few minutes to explain why was it that this idea became general that money could not be left in the market, and what are the fundamental weaknesses or flaws in that presumption that the state has to do it rather than competition?
Well, if you look at the countries that created central banks, it was mostly for fiscal reasons. It was because the government likes to have a captive bank that will lend it money when the need arises. And of course, nowadays the need is chronic. But if you look at the early history of the Bank of England, it was created as a private monopoly. It wasn't yet state-owned. And the relationship between this bank and the patron government that had chartered it and kept renewing its charter and kept excluding competition with that bank became very cozy. And the way in which the Bank of England was given a monopoly weakened all the other banks in Great Britain, well, not in England and Wales. There, for strange historical reasons, there was a separate system of banking regulation and law in Scotland. So Scotland escaped this fate. But the banks in England outside of the London area, where the Bank of England had a monopoly, were very weak, and they failed frequently. And so that was made the reason for, well, we have to give the Bank of England control over everything, because you see, you can't trust these small competitive banks that keep failing. In Scotland, there wasn't any opinion of that sort. The banks were all adequately capitalized and well diversified. And you see much the same contrast between the United States and Canada. So the US had a system where, mostly through geographic restrictions, the banks are not allowed to branch across state lines and even within states in many cases. And the banks are poorly capitalized. They're often, the charters are given to favorites of the state legislature. And so the banks do fail in droves when bad things happen. And that becomes the pretext for creating more regulation to try to strengthen the banking system. You can think of the Federal Reserve Act as an attempt to cure the panics, and the panics were due to the weakness, the regulated weakness of the US banking system. Meanwhile, north of the border in Canada, the banks are branched nationwide, they're well capitalized, they're well diversified. There's no movement to create a central bank. It wasn't until even the 1930s that they created a commission to look into having a Bank of Canada. And of course, the verdict was already in the pocket. But 2 of the 5 members of the commission said, we don't need a central bank. What are you talking about? They were the one banking representative and a former finance minister. So it was a case of the dynamic of interventionism, where the banking systems in countries that were made weak by monopoly privileges and other kinds of restrictions, that weakness then became the pretext for giving more control to a government institution.
Well, in our system today in the United States, for instance, it's taken for granted that the Federal Reserve needs to have the authority to determine the quantity of money in the economy, the cash or the deposits and so on, and also a responsibility to be influencing interest rates. They kept them near zero for so long following the financial crisis of 08, 09. They now seem to be nudging them up. Could you perhaps explain a little bit, why isn't it necessary for the government to determine how much money we have in the economy, and what may be the negative effects of government influencing interest rates, that obviously influences the economy as a whole.
Well, we made a very important change from a gold-based system, a commodity money system, to an unbacked or fiat money system gradually in the U.S. But the last step was in the 1971 when Nixon shut the gold window. But going back to the 30s, FDR took the U.S. off the domestic gold standard, so U.S. citizens were actually prohibited from owning monetary gold. In a fiat money system where the basic money is not a claim to gold or not gold itself, but only an IOU nothing, to use John Exter's phrase, just an item on the Fed's balance sheet, the central bank does have to control the quantity of basic money because only they can control it. So it becomes a policy issue, whereas under a gold standard, it regulates itself. Money flows in and out of the national economy in order to equilibrate the quantity of money to the quantity people want to hold. It's a gradual process that nobody even pays attention to. And interest rates are set in financial markets. But in our current system, the Fed has to control the quantity of money, and the feedback mechanism they use is their control over short-term interest rates. They used to do it in terms of something called the federal funds rate, which is the interest rate between banks, but they pretty much squashed the Fed funds market in recent years by paying interest on reserves, to the point where every bank has excess reserves now, so no bank needs to borrow reserves. So instead, the Fed has this crazy system where they pay interest on reserves, that's one rate, and they conduct reverse repurchase operations. The details are not really important, but anyway, the Fed has these two administered rates that form a corridor, or a ceiling and a floor, and they try to keep short-term interest rates between those two. So they've gotten very much mired into financial markets, and as you're saying, intervening into what should be determined by competition in the marketplace.
Well, the thing is that we normally think that prices provide certain important feedbacks in an economy. First, interest rates are a price that are supposed to bring into balance the demand to borrow funds with the willingness of people to save and lend their funds. We think that it's meant to be a check that investment doesn't get overextended other than the amount of real resources that people have put aside in the form of their savings.
Right.
So in other words, there isn't a mismatch between savings and investments in terms of the investment horizon, if you will, and the time when investments would be able to be maturing and be, paying back the loans undertaken, et cetera. Now, given that, if that's true in the general sense, given that the Federal Reserve has manipulated interest rates for the last decade so dramatically, near zero for certain key ones, isn't that almost as if we've had financial markets without a price mechanism?
Well, we have financial markets with an interfered price mechanism. So yes, these real forces of saving and investment still operate, and they will still work to reestablish a market interest rate. But when they come into conflict with monetary policy, then we have a problem. We have a conflict. We have not coordination, but discoordination in the market. So if the Fed tries to establish interest rates that are different from market rates, then we get problems of malinvestment and business cycles. I'm not sure that the low rates of recent years are entirely the Fed's doing. I think they have created a reluctance to invest, which is helping to keep interest rates down. So I haven't seen the money supply growing the way you would expect, that is M1 or M2, if it was purely the Fed keeping the market awash with liquidity. So they've made things quite confusing by injecting literally trillions in bank reserves and then paying banks not to lend it out and not to create deposits.
So in a sense, this has created a problem that financial markets cannot be, if you will, functioning in the way they're meant to in an overall economy, because people have a hard time knowing what they should be doing, because an essential price signal is significantly distorted. As you were saying, I mean, right. If people have a demand to borrow, but some government agency imposes a price ceiling, then there's got to be a distortion. And by keeping interest rates low, and that's really what I meant, is no functioning price system in the financial market, then you're going to cause these imbalances between the two sides of the market that are then difficult to sort out without another crisis of some type at some point.
So in a freely coordinated system, people look at interest rates and they can count on those being, organic. They can count on those being reliable. They still have to do some forecasting, but at least they don't have to try to forecast what the central bank is going to do to change interest rates in the near future. So there's this great uncertainty created by having an active central bank that's interfering with interest rates, and discourages investment. It discourages long-run planning. And we've seen the real growth rate in the U.S. economy slow down in the last 15 years. It's quite disturbing.
Larry, you mentioned about what happened during the 1930s, and I wonder how many people recognize really how monumental that was. I mean, here gold coins and silver coins had been the official money of the American people under the Constitution. I mean, you have provisions that say no state shall make anything but gold and silver coin legal tender.
That's still in the Constitution.
It's still there, and there certainly is no power, enumerated power of the federal government to make fiat money the official money. And I find it absolutely astounding that the Roosevelt administration could actually just nationalize what had been the official money of the American people, and to turn Americans who insisted on continuing to own their gold coins in secret into felons. Mm-hmm. I mean, because it was made a felony offense.
With the cooperation of Congress, let's not let them off the hook.
Right.
That's right. Yeah, so Federal Reserve notes used to say, we'll pay the bearer on demand in lawful money, meaning gold or silver. Then they just removed that, and it says, now, in God we trust. No, actually it just says legal tender for all debts, public and private. So if you have a debt denominated in dollars and you're paid with one of these notes that's no longer redeemable, you can't go to court and say, look, I haven't been paid what I expected to be paid. People did go to court in the 30s, and the court said, oh, sorry, the government decided that this is an emergency and it would be inconvenient to have to pay you in gold, so you're out of luck.
Yeah, and it was a criminal offense. I mean, I think there was a couple of instances where they indicted a guy for owning gold coins, but it didn't go very far because I think they were afraid of having the courts rule on it. But, I mean, there's that fear factor. I mean, do you want to risk a felony conviction for owning some gold coins? I think most people would say no, and they turn their gold over to the government.
Well, especially the banks turned their gold over to the government. They had most of the gold. And, of course, they were being regulated from above, so they had to turn it over.
Yeah. Now, go ahead, Richard.
Okay. Yeah, I was just going to say, ask you, given all of these problems that monetary theorists such as yourself point out about the sordid history of the emergence of central banking, the fundamental problems and limits of it, then the idea comes, well, then if such arguments were to be taken seriously, the freeing of the banking system. Now, this raises the issue that is a hot one, and that has to do with the emergence of cryptocurrencies and Bitcoin and so on. And I was wondering if, again, for our viewers and listeners, if you could perhaps briefly give your read on the significance of the emergence of things such as Bitcoin, and what potentially could cryptocurrencies represent. Is it just sort of a fashion or a fad? Could it, in the right circumstance, actually represent an arena of the emergence of currencies of choice in comparison to central bank money or not? If you get what I'm asking.
Yeah, so it's a very exciting development. I think it's too soon to say exactly how far it will go and how important it will become to the broader financial system, but it's quite remarkable. It's in a sense something I have been following closely because we're all familiar with Hayek's denationalization of money, where in the 70s he says, why do we have such high inflation? Why do we have such terrible money? Because governments have quashed competition. So what would it look like if we had competition? And he imagines a world in which you have private issuers of unbacked money, says gold standard, old-fashioned, might be the choice of the public, but I'm going to assume it's not. So let's imagine what private unbacked money would look like. And he says, I imagine that the issuers would give you a money-back guarantee. They would keep the purchasing power constant in terms of some index. Bitcoin comes along, and that's absolutely not what it does. It's privately issued, but all it guarantees is the quantity of Bitcoin in circulation. Doesn't guarantee you the purchasing power. And it turns out that's kind of built into the kind of program it is. But it takes off. It becomes worth hundreds of billions of dollars. It's quite remarkable. So it gives some hope that and it certainly has alerted a lot of people to the possibility of privately issued money. Now, it's not gold. It's not redeemable for gold, and it doesn't have the stability of value in the long run that gold has, because it doesn't have the kind of supply feedback mechanism a gold standard has. Right? Under a gold standard, if the purchasing power of gold goes up, the miners will dig a little deeper, more prospectors will go out, and in the long run, maybe 20 years, 30 years, you'll get the purchasing power of gold coming back up. Sorry, did it go down or did it go up to begin with? I forgot. But if it goes down, it'll come back up. If it goes up, it'll come back down. And in the long run, you can see this in the data, the price level at the end of a gold standard period in the United States was about the same as it was at the beginning. If you compare 1879, when we rejoined the gold standard, to 1914, when we created the Fed, price level is virtually identical according to most measures. So it has this trend reverting characteristic the gold standard does. Bitcoin doesn't have that. So it's much more volatile in its price. And that limits how attractive it is to people as a transaction medium. You don't want to be holding the money to pay your rent check in Bitcoin when it could drop 20% tomorrow. Right? It's just too risky. And your landlord probably doesn't want to be paid in Bitcoin for the same reason. So it's having trouble getting a critical mass of people to use it as a medium of exchange. There are some people using it for some purposes as a medium of exchange. It's just not very common. So it remains to be seen whether the base of Bitcoin users can be broadened given this inbuilt volatility. It's got a second problem, which is the transaction mechanism gets congested at fairly low levels. It can't handle anything near the volume of payments that MasterCard or Visa can handle. So people are working on technical solutions to that, but remains to be seen whether they'll solve that problem.
Now, part of the volatility of Bitcoin and some of these others that you were pointing out, in more recent times, I mean like the last year or so, has now brought about a situation where political authorities and spokesmen for central banks say, now you see, we have to bring this under some type of regulatory management under the ambit of the central banking system. Maybe you could comment.
That's the moderate response. Many central bankers have been saying we have to crush it because all it's good for is tax evasion and money laundering and black markets. So it has, Joe Stiglitz is famous for saying, it has no social purpose, so we should ban it. Just no concept that we should let the market try to develop it until we see whether it has, how popular it is, how useful it turns out to be.
So, Larry, is it true that it really is secret? I mean, can people doing drug transactions and other illegal things, can they really keep these transactions, buying and selling, secret from the government?
Well, the guy who was running the Silk Road drug website found out the answer is no, right? It's not anonymous, it's pseudonymous. So the Bitcoin blockchain records all the transactions, and that it records them by your IP address. So if you haven't hidden your IP address somehow, if you haven't successfully faked an IP address, the government can track down your internet service provider, and this is what happened in the case of the Silk Road website, pressured them to give up the identity of this customer, and they did, and in came the feds. So no, it's not anonymous. Now, there are ways of anonymizing your IP address. That's getting a little too deep into the technology for my expertise, but yeah, it's actually not that attractive because the anonymity is not that deep. There are other cryptocurrencies that promise more anonymity, but if they become popular, I don't expect the authorities to just stand by. Already, the Treasury is requiring cryptocurrency exchanges to know their customers, the way banks are required to know their customers. So federal government's already getting involved.
One other thing that I think our viewers and listeners might be interested in, if they follow some of these debates about money and the government, is this push by some to a cashless economy. It isn't the idea of people choosing to do this, but the government basically taking cash out of circulation. Everything would be electronic and computerized. If you could talk about two things, the economics of that and the politics of that.
Yeah, so many people have talked about there being a war on cash. Mm-hmm. And many of the same economists, Joseph Stiglitz, Paul Krugman, and recently Ken Rogoff has a book on this topic, those who want to suppress Bitcoin or cryptocurrency because they think it's a vehicle for criminals, also want to suppress cash for that reason. So in some countries, and Sweden is perhaps the farthest along, they haven't banned cash, but they've made it much less useful than it is in other places. And as long as that's voluntary on the part of the public, that they want to move their transactions to debit cards, I've got no problem with that. I was in Sweden a couple of years ago and tried to buy a ticket on the tram with cash, and they wouldn't take it. Yeah, fortunately, they didn't throw me in jail for offering it. But so this has become a kind of worldwide movement. There's even an organizing group called the Better Than Cash Alliance, which combines the United Nations and the fiscal authorities in many developing countries who want to collect taxes, together with some payment service providers. Visa, MasterCard, Citibank are involved in this project. And they're going through the developing world and trying to convince people, give up cash, adopt electronic means of payment so that we can track you and make sure you're paying your taxes. And maybe I shouldn't just say encourage. They're putting restrictions on the use of cash in many places. So this movement has already claimed the 500 euro note. The European Central Bank has agreed to withdraw the 500 euro note from circulation. But Rogoff in particular is pressuring Charles Goodhart and others are trying to shame central banks into removing the largest denomination currencies on the grounds that, criminals use them. The point I've made in writing about this is, yeah, but ordinary people use them too. So you need to consider that you are removing an option from people that's has perfectly legitimate uses. People don't carry a lot of $100 bills, but they do when they're making large purchases. They do when they go on vacation. And so those things have to be considered. It's not just criminals that use large denomination currency.
Larry, what is the role of the FDIC in all this, in the concept of free banking and abolishing the Fed, the Federal Deposit Insurance Corporation?
Well, After the Federal Reserve failed to prevent the panics, we created the Fed in 1914. In the 1930s, we had 4 or 5 panics as people lost their faith, especially in small rural banks. The Fed didn't stop that. Then we got the FDIC as the next attempt to backstop the weak banks in the system. So I would say the FDIC is sort of a substitute for having a freely competitive system where banks have the wherewithal and the desire to create sound reputations for themselves. Right? So there isn't any movement for deposit insurance in Canada because people aren't losing money in bank failures. The FDIC looked like it was sort of a free lunch for a long time because it did stop the bank runs and it didn't seem to cost the public anything. But we discovered in the 80s and 90s with the collapse of the savings and loan industry and the bankruptcy of the FDIC in 1991, because they were paying out so much to bank depositors in big bank failures, that the FDIC creates a lot of moral hazard. It gives banks a subsidy to take risks, because a bank can now take a risk without losing customers or without having to pay higher interest rates to depositors to attract them. So we found out it actually is a lot more costly than it had looked for a while. The FDIC was reformed supposedly in 1991, and it was supposed to have the power to prevent big bank failures by keeping close tabs on banks' capital, and when it got too low, they were supposed to intervene before the bank became insolvent. And what happened in 2007? Nothing. The FDIC did nothing to prevent huge banks from going under due to the bad mortgages.
In a free banking system, surely banks would see their own self-interest to either singularly or through some bank associations to offer insurances for depositors, would they not? The same way then you buy an appliance, you have a certain warranty or guarantee. Certainly there'd be some variation on that theme that private banks in a free banking system would see for having a network to give a greater sense of confidence on their depositors, would they not?
Well, in the United States, the clearinghouse associations of the commercial banks did that to a large extent. But the U.S. is actually pretty unusual in that respect, because in other countries, the question didn't even arise of somebody backstopping the banks, because the banks established their own reputations, kept their own reserves, and were careful not to make their own reputations commingle with the reputations of other banks. They maintained distinct identities. So if the bank across the street was in trouble, there wasn't any reason to infer that your bank was in trouble and get nervous about your account. So clearinghouses didn't play such an active role. In the U.S., they did. They had membership requirements, so they enforced minimum capital on their member banks. And when the need arose in a financial panic, they arranged last resort loans to the members who were illiquid but fundamentally solvent. So these roles, the Federal Reserve System basically nationalizes. They basically copied what the clearinghouses were doing and turned it into official policy.
Larry, if people want to learn more about these concepts, what would you recommend? Do you maintain a periodic blog yourself, or what books or websites would you recommend people to go to?
Well, I recommend Richard's book that you mentioned earlier.
Thank you.
I blog at a Cato Institute site called altm.org, alt-m. So I have an essay about once a month. It's less of a blog in the old-fashioned sense of sort of daily diary than it is a sort of series of essays, 2,000 words or so. My first book, Free Banking in Britain, which is about the Scottish free banking era and the debate over central banking versus free banking, is available as a free download from the Institute for Economic Affairs in London. So it's a free PDF if anybody wants to read that. My most recent book is The Clash of Economic Ideas, which is a kind of tour through the interesting parts of the history of economic thought. But it has a couple of chapters that sort of summarize the history of banking and money and what economists have had to say about it, including the people who I think had the right ideas, who understood the issues in free banking. That's something you won't get in typical money and banking textbook.
All right.
I would just mention Larry's own book from several years ago, your Theory of Monetary Institutions.
Yeah, that's out of print, but it's still available in the used book market.
Mm-hmm.
You want to Google shop for it.
Yeah. All right. Well, Larry, thank you very much for coming on the show. It's a big honor that you would take the time to join us and share your perspectives.
Oh, I'm honored to be on.
Yeah, this is the key to political power, greatness, and so forth to appear on Libertarian Angle. I wouldn't be surprised that you might get a call from Trump. Some kind of
This is a true story. The chairman of chairman of Cato Institute for several years was John Allison, who's a former banker and somebody I got to know pretty well. And he was mentioned as a possible Trump appointee to head Treasury. And I had a nightmare one night that he called me and said, "I've taken the job. Would you come to work for me in Washington?" and I screamed, "No!"
Richard, any parting comments here?
Just that I just want to thank you also, Larry, for being on the show. And besides, we see each other so infrequently. It's great to see you this way. It's
Yeah.
good to see you. And I know our viewers and listeners will really value very much your views and insights on these things. So thank you.
Okay, keep up the good work.
Yeah, thanks for joining us. And for people who want to know more, including finding Richard's great book, Monetary Central Planning in the State, which continues to sell well on Amazon, come to our website at fff.org. And thank you again, Larry and Richard. I look forward to talking to you next week.
Take care.
Yeah.
Bye-bye.